Welcome, curious listeners, to another deep dive into the most compelling topics shaping our world today.
Great to be here.
Today, we're plunging headfirst into a subject that often feels like the Wild West of modern finance: the dynamic, ever-evolving landscape of crypto assets and the rapidly accelerating efforts to regulate them.
Yeah, it's a space that changes almost daily, it feels like.
Absolutely. And we've had some truly fantastic source material shared with us for this deep dive, including a really forward-looking report from Novark Services that examines global frameworks and India's legal evolution, which is fascinating in itself.
Interesting.
And also a deeply comprehensive report from the US Treasury, specifically the Financial Stability Oversight Council, or FSOC, detailing digital asset financial stability risks and regulation. That one's a heavy hitter.
Oh yeah, the FSOC report is definitely core to understanding the U.S. perspective on risks.
Our mission today, as always, is to unpack these sources, extract the most important nuggets of knowledge, and give you a real shortcut to being incredibly well-informed about the complex, often dizzying world of cryptocurrency regulation.
Trying to make sense of the noise, basically.
Exactly. We'll explore why these regulations are becoming so critically important, the inherent risks within the crypto ecosystem that policymakers are grappling with, its surprising and growing connections to traditional finance.
Which are maybe bigger than some people think.
Right. And how historical precedents are actually guiding policymakers right now. It's fascinating stuff.
Yeah, those historical parallels are really quite striking sometimes.
And why does this all matter to you? Well, whether you're an investor navigating these waters, a business owner contemplating blockchain solutions, or just someone who genuinely wants to understand the powerful forces shaping our modern economy, gaining clarity in this space is absolutely crucial.
It really is. It touches more than just finance now.
It's about more than just digital money. It's about financial stability, public trust, and perhaps most importantly, protecting the very spirit of innovation. So let's unpack this.
Let's do it.
Okay, so to start, let's just make sure we're all on the same page. When we talk about digital assets, and specifically crypto assets, what precisely do we mean? The terms get thrown around quite a bit, sometimes interchangeably, so a clear definition feels like a good starting point.
Yeah, absolutely essential because how we define these foundational terms really shapes everything else. The U.S. Treasury report, for their purposes, clarifies that digital assets is actually a broad kind of umbrella term.
Okay.
It covers two main things. On one side, you have Central Bank Digital Currencies, or CBDCs. Think of those as like a digital dollar issued by the Fed, potentially.
Right, the official version.
Exactly.
Yeah.
And on the other side, you have what they call crypto assets. And that's mostly what we're diving into today. The report defines these as private sector digital assets. So, not government issued, that rely primarily on cryptography for security.
Hence the crypto.
Right. And on distributed ledger technology, DLT, for how they work and how records are kept. These are what most people are thinking of, the coins or tokens, Bitcoin, Ethereum, things like that.
Okay, so private sector, cryptography, DLT.
Got it. And what's particularly interesting, I think, is the distinction the report makes. An equity security, like a stock share, right? It might be represented digitally. Maybe you see it in your online brokerage account.
Sure.
But unless its ownership is fundamentally determined and recorded on a distributed ledger technology, rather than through, centralized records kept by the stock exchange or the company's registrar, it wouldn't be classified as a crypto asset in this specific context.
Okay. So it's not just about being digital. It's about how ownership is tracked using that DLT.
Precisely. The key insight there is that the underlying technology that determines ownership, specifically DLT, is the core differentiator. That's what makes it a crypto asset according to this framework.
So DLT, or distributed ledger technology, is clearly a foundational element here, much more than just, say, Bitcoin itself, right? What are some of the other interesting technological innovations and financial products built on top of this technology that the Treasury report highlights? Things that are pushing the ecosystem forward. It feels like there's always something new popping up.
Oh, absolutely. DLT has basically opened the floodgates for a whole wave of innovation beyond just, sending currency from A to B. A really significant development, and one that underpins so much of the newer activity, is this concept of the smart contract.
Okay, heard that term a lot. What exactly is it?
So the Treasury report describes a smart contract as basically a piece of computer code.
Yep.
And this code is deployed directly onto a distributed ledger, onto the blockchain. Its whole purpose is to automatically initiate changes or execute the terms of an agreement once certain predefined conditions are met.
Like an automated agreement.
Exactly. Think of it like a sophisticated vending machine for agreements. If you put in the right amount of crypto, maybe the digital asset automatically transfers or a service gets triggered. No need for a human intermediary to approve it or enforce it, in theory.
Ah, I see. Takes the middleman out.
In principle, yeah. It allows agreements to be automated and self-executing, which means you don't necessarily need a traditional third party, like a lawyer or a bank, to mediate or enforce the contract. Now, many of the newer crypto asset innovations, especially in the area called decentralized finance, or DeFi, rely very heavily on these smart contracts. They're kind of the building blocks for these more complex financial applications.
Okay, so DeFi is built on smart contracts. Makes sense. What else?
Well, another fascinating development, closely tied to smart contracts, are things called oracles.
Oracles, like predicting the future.
Not quite like Delphi. But smart contracts, by their design, usually only operate with data that's already on their blockchain. They're kind of siloed.
Right.
But what if a contract needs information from the real world? Like, imagine an insurance smart contract for a farmer. It needs to know if rainfall targets were met to automatically pay out, right? Or maybe a derivative contract needs to know the price of oil or the outcome of some macroeconomic event.
Okay, stuff that's not on the blockchain itself.
Exactly. Blockchains are typically isolated from that external data. Oracles are basically designed to bridge that gap. They provide smart contracts with access to this off-chain information, securely bringing external data onto the blockchain so the smart contract can react to it.
Ah, okay. So they feed real-world data into the smart contract.
Precisely. So you can see how these innovations kind of layer on top of each other. DLT enables smart contracts plus oracles enable more complex, automated financial products that can actually interact with real-world events. It's pretty clever, technically.
It is, but, the market has certainly grown, attracted tons of attention, tons of capital, but it's been a pretty bumpy ride for a lot of people, hasn't it? Volatility seems almost baked in.
Oh, definitely. Bumpy is an understatement sometimes.
So what other key features define how these crypto assets and the activities around them actually operate, according to the Treasury report? What makes them unique, operationally speaking, beyond just the tech?
That's a crucial point. The Treasury report definitely notes that while there's been substantial growth attracting both retail folks and big institutional money, this expansion has been punctuated by, and I'm quoting here, investment booms, alternating with crashes, failures, and bankruptcies.
Yeah, we've certainly seen those headlines.
Right. And this inherent volatility and the risks it brings are directly linked to several key features of the crypto asset world that make it very different from traditional finance.
Okay, like what?
Well, first there's this concept of near-immutability. Transactions recorded on a distributed ledger are often described as nearly immutable. Once they're processed and confirmed on the blockchain, they are incredibly difficult, maybe even impossible to reverse or change.
Okay, sounds secure on the surface, like nobody can mess with the records.
Exactly. Proponents will often point to that, saying it offers superior data integrity, great auditability, makes records transparent, and tamper-resistant, which, has advantages.
But there's always a but.
But the flip side is that very immutability also makes these transactions really tempting targets for hackers or scammers. And more practically, if an erroneous or fraudulent transaction happens, so you accidentally send your crypto to the wrong address, which is easy to do with those long strings of characters.
Yeah, I can imagine.
Or you fall victim to a phishing scam. It's exceedingly hard to fix or undo that transaction. The key thing is the undo button just doesn't exist in the same way it does in traditional banking, where you might be able to reverse a charge or recover funds.
Wow. So user error is potentially catastrophic.
It demands a really high level of personal vigilance and, frankly, technical understanding. And this has huge implications for things like bankruptcy proceedings or trying to recover stolen assets. It makes everything far more complicated than in traditional systems.
Okay, immutability. What's next?
Second big feature, pseudonymity. Market participants and their transactions are often publicly identified only by these complex strings of characters, public keys, or wallet addresses. You can see all the transactions on the public ledger. It's transparent in that sense.
Right, you can see address A sent X amount to address B.
Exactly. But the identity behind address A or B isn't readily apparent just from looking at the blockchain. This can offer a degree of privacy, which some users value highly.
Okay. But again, the downside.
Well, the opacity created by this pseudonymity makes it much harder for regulators and even other market participants to monitor the connections between different entities. And that's vital for understanding systemic risk, who owes what to whom, basically.
Right, you can't see the whole web.
Precisely. And unfortunately, this feature can also be exploited by bad actors trying to evade legal or regulatory obligations, like anti-money laundering rules. They use techniques like mixer services that pool and scramble crypto from different sources to obscure its path, or converting funds into privacy coins, which are cryptocurrencies specifically designed to hide transaction details even more.
So it helps hide illicit activity.
It can, yes. Although the report makes an important point. For many retail users, this privacy benefit is actually largely illusory if you're accessing crypto through a major exchange or intermediary.
Like Coinbase or Binance.
Yeah, exactly. Those platforms typically verify your real-world identity anyway through Know Your Customer or KYC checks. So the exchange knows who you are, even if the blockchain address itself is pseudonymous.
Ah, okay, so it's not truly anonymous for most everyday users interacting via exchanges.
Not usually, no. Third point, and this is a really significant difference from traditional finance, is the common practice of combining financial activities within a single crypto entity.
What do you mean by that?
In traditional financial markets, you generally have different regulations and different types of firms for different activities. Like your broker is separate from the exchange, which is separate from the bank holding your deposits, which is separate from the lender. There are walls built between them.
Right, specialization and separation.
Exactly. It's a deliberate design to manage risk and prevent conflicts of interest. But in the crypto space, it's very common for a single entity or platform to combine all of these things. They might offer trading, custody your assets, act as a market maker, provide margin lending, issue their own stablecoin, offer high-yield accounts, all under one roof.
Sounds convenient, maybe. One-stop shop.
It sounds convenient. But the Treasury report flags this as creating inherent conflicts of interest and significantly amplifying financial stability vulnerabilities, especially if these combined activities are mixed with high leverage or really concentrated investments.
Because if one part goes bad.
It can potentially bring down the entire integrated operation. There aren't those firewalls. And the conflicts are real, like, is the platform acting in your best interest as a broker, or its own interest as a market maker or lender against you?
Yeah, I can see the problem there. Okay, what else?
Finally, the report highlights retail investor access to sophisticated products. In the crypto world, individual consumers, retail investors like you or me, often gain access to products and financial arrangements that are usually not available to them on a retail basis in the highly regulated traditional markets.
Like what kind of products?
Things like extremely high leverage, sometimes 10x, 20x, even 100x on derivatives, or complex lending arrangements that are structured more like securities lending or repurchase agreements, things usually reserved for institutional players. And while this might seem like it's democratizing access, offering more opportunity, the report cautions that it also carries significant risks. Because these products are complex, they can lead to rapid, substantial losses if people don't fully understand them or how to manage the risk. And often, the usual investor protections you'd expect in traditional markets just aren't there.
So, more access, but maybe less safety net.
That's a good way to put it. It puts a lot more onus on the individual to understand exactly what they're getting into.
Okay, so we've sketched out the crypto ecosystem's unique features, the tech, the volatility, the combined functions, the risks. But let's pull back the lens now. How tightly woven is this often volatile digital world into the fabric of our traditional financial system? Are they really separate spheres, or is there an increasingly intertwined web developing?
That's a really crucial question for stability. Stepping back to look at the bigger picture, the U.S. financial system, as the Treasury report emphasizes, is fundamentally built on principles of stability and safety. Confidence in the system has been painstakingly built over many, many years, lots of regulation, making U.S. financial markets generally seen as a safe place globally.
Right, stability is key.
Absolutely.
Okay.
Now, the report notes that as of when it was written, the overall involvement of the traditional banking system in crypto activities remained relatively low. So it wasn't pervasive yet.
Okay, so not systemic risk just yet, maybe.
At that point, likely not from banks alone. But, and this is the key point, these connections are undeniably increasing. And that's where the potential for broader systemic risk starts to creep in, even from initially small exposures.
How are they increasing? What are the connection points?
Well, think about basic banking services first. Deposits, payments, settlements. These are routinely used by crypto ecosystem participants, exchanges, stablecoin issuers, crypto companies, this is often done through a small number of specialized banks that have sort of carved out a niche catering to the crypto industry.
Okay, providing the plumbing, basically.
Exactly. But the connections go deeper than just basic services.
Mm.
Some banks are providing much more niche, specialized products directly related to crypto.
Like what?
For instance, some might offer proprietary permission blockchain systems, their own private blockchains, to enable faster transfers among their crypto-focused customers. You also see traditional banks providing collateralized lending against customer crypto asset holdings.
So using Bitcoin as collateral for a loan from a regular bank.
Potentially, yeah. Or offering crypto asset custody services, securely holding digital assets for their clients, which is a big need. Some banks are enabling retail access to crypto buying and selling directly through their own platforms or apps, and even providing traditional investment banking services, like advising on mergers or helping raise capital for venture capital funds focused on crypto or crypto companies themselves.
So banks are definitely dipping their toes in
Oh,
various ways.
more than dipping in some cases. It shows a growing acceptance and integration, even if it's concentrated in certain banks.
And what about stablecoins? You mentioned them earlier. They're supposed to be stable, often backed by dollars held in banks, right?
Yeah.
How does that specific connection play out?
That's a really critical nexus, probably one of the most direct links right now. The report highlights that some banks are indeed partnering with stablecoin issuers, specifically by holding their reserve assets. So the traditional dollars, or safe assets, that are meant to back the stablecoin's value are sitting in accounts at these banks.
Which makes the banks pretty essential to the whole stablecoin idea working.
Absolutely. They're a core part of the stablecoin's supposed stability mechanism. And it goes further. A small but growing number of banks are even exploring or have publicly announced intentions to issue their own stablecoins, or something similar called tokenized deposits on blockchain systems.
So the banks own liabilities, but represented on a blockchain.
Exactly. That signals a potentially much deeper integration where traditional banking itself starts really leveraging DLT. Now, while the report states that current exposures for banks are limited, meaning a crypto shock today probably wouldn't cause major losses to the banks themselves, it delivers a very clear warning
Which is?
that small exposures have the potential to grow rapidly. This is especially relevant because banks are openly saying they're basically waiting for more regulatory clarity, for the green light from regulators, before they really scale up their involvement.
Ah, so once the rules are clear, the floodgates might open.
That's the concern. What stands out to you about how quickly these connections could accelerate once that regulatory clarity arrives? It could potentially transform the landscape pretty fast, connecting crypto much more deeply into the core financial system.
Yeah, it feels like pent-up demand almost. Okay, so banking connections are growing. What about beyond banks?
Well, beyond the direct banking system, there's also a significant and growing stream of private investments flowing into crypto entities.
From who?
From firms that traditionally deal with other types of risky or alternative assets. Think large asset managers, hedge funds, venture capital funds, private equity, even wealthy family offices.
So the big players in traditional finance are investing in crypto companies.
Exactly. These private investments provide direct exposure to crypto developments for these institutional investors. Often it's through investing in privately held crypto companies, exchanges, infrastructure providers, DeFi protocols, companies that have received really substantial funding rounds from these traditional financial players. So even if a crypto company isn't publicly traded on the stock market, traditional finance is still pouring substantial capital into them, creating this indirect but really significant link.
Okay, so institutional money is flowing in. But it sounds like there are also many ways for regular people like you or listener to get involved in this market, even if it sometimes feels distant or technical. What does the report tell us about these retail on-ramps and just general public adoption? It feels like more everyday people are engaging with crypto.
Exactly. Consumers and retail investors have definitely found numerous ways to get exposure. Many interact directly with crypto outside traditional finance, using specialized crypto asset platforms or apps.
Right, directly signing up with a crypto exchange.
Yeah. But the report cautions that this carries significant risks, especially if the products offered on those platforms aren't compliant with existing securities or commodities laws,
Well,
which unfortunately has been a common issue, leaving investors potentially vulnerable without standard protections.
Okay, what other ways?
Well, beyond the big online platforms, consumers can also buy crypto from things like Bitcoin ATM kiosks you sometimes see in stores.
Right, I've seen those.
Or they can engage in direct peer-to-peer transactions using what are called unhosted wallets, software, or hardware wallets, where they control their own private keys. That gives them direct control, but also direct responsibility for security.
Okay. Are there ways within the traditional system too?
Yes, and this is growing. Even within the traditional system, you can sometimes purchase publicly offered crypto-related products, maybe through a broker, or access crypto through firms that provide other financial services like money transfer services or some newer fintech apps. For example, some third-party providers now integrate the ability to buy and sell crypto assets directly into banks and credit unions' existing online services.
Ah, so it's becoming embedded in familiar platforms.
Exactly. And what's particularly striking is the adoption data the report cites. The Federal Reserve's survey of household economic decision-making found that 12% of U.S. adults use or held crypto assets in the past year.
12%, that's actually higher than I might have guessed.
It is significant. And other surveys like those from Pew Research Center and NBC News mentioned in the report actually put that figure even higher, somewhere between 13% and 20%. So maybe 1 in 5 or 1 in 6 adults have some involvement. And the report also notes an interesting demographic trend, that racial minorities are relatively more likely to gravitate toward Bitcoin and other crypto assets. Perhaps, some speculate, seeing them as an alternative or more accessible path compared to traditional financial systems where they might have faced barriers.
That is interesting. Okay, what about more niche connections? Things like insurance or even mortgages. Are those becoming avenues for interconnection between crypto and traditional finance? It feels a bit strange to hear crypto and mortgage in the same breath.
Yeah, it does signal how far the tendrils are reaching, even if these connections are still pretty small. Prospectively, the report points out that insurance policies for crypto firms are an emerging channel. Things like covering cybersecurity risks or losses from digital wallets that reflects the unique risks of the industry needing traditional insurance products.
Okay, ensuring the crypto businesses themselves.
Right. And you're right about mortgages. It might sound surprising, but some mortgage finance companies have actually originated mortgages that were collateralized by crypto assets.
Meaning someone pledged their crypto to help get a home loan.
Eventually, yeah.
Yeah.
Using their crypto holdings as part of the collateral package. There were even plans discussed to pool these crypto-backed mortgages into securitized bonds to be sold to investors, though the report notes the scale of this activity has been, so far, very, very small.
Okay, tiny for now.
Very tiny. And furthermore, one mortgage company even briefly tried accepting crypto for mortgage payments, but they ended up discontinuing that program. The main concern here, as the report highlights, is pretty obvious. How does the extreme volatility of crypto prices impact a homeowner's ability to meet their mortgage terms if the value of their collateral or the asset they're paying with fluctuates wildly?
Yeah, that sounds incredibly risky for a homeowner.
It poses a very direct risk to household financial stability.
Yeah.
So even these small sort of nascent connections could become quite significant points of vulnerability if they grow without being properly managed and understood.
Okay, so it's clear traditional finance isn't entirely walled off from crypto. The connections are growing. But the sources, especially the Treasury report, also dive deep into the inherent vulnerabilities within the crypto ecosystem itself. Forget the outside connections for a moment. What are the major internal fragilities, the cracks in this digital foundation? This feels like where it gets really interesting and maybe a bit scary.
Indeed, this is where the core fragilities of the system itself become really apparent. The Treasury report meticulously details these internal vulnerabilities, and what's critical to understand is that they often don't exist in isolation. They tend to feed off each other, amplify each other, creating this potential cascade of risks that can unravel surprisingly quickly.
Okay, so what's vulnerability number one?
First, let's talk about crypto asset prices themselves. Their extreme volatility, the apparent lack of traditional fundamentals anchoring them, and the pervasive issue of manipulation. Crypto asset prices are, as you said, incredibly volatile. That's probably the first thing anyone notices.
Yeah, wild swings are common.
Right. And unlike, say, a stock price, which is theoretically linked to a company's earnings and future prospects, or a bond price linked to interest rates and creditworthiness, many crypto assets seem to lack a clear, fundamental economic use case right now that anchors their value in the present. The report explicitly states that retail participants are particularly exposed to potential market losses because of this.
And the data backs that up.
Oh, yeah. Starkly. A Pew Research Center survey cited found that 46%, nearly half of Americans who held crypto, reported their investments did worse than they expected.
Ouch. Almost half did worse than expected.
Yeah, compare that to only 15% who reported better than expected results. That demonstrates a really significant disconnect between the hyper expectation and the actual financial reality for many retail investors.
So if these prices aren't really tied to traditional economic indicators like earnings or interest rates, what is driving them then? Is it just pure speculation?
That's the fundamental question, isn't it? The report states quite plainly that fundamental economic use cases do not currently anchor prices of many crypto assets. Instead, it suggests prices often seem to reflect speculation about whether future economic use cases might develop, balanced against the probability that they might not. It's betting on the future potential.
So more sentiment-driven than value-driven, maybe?
Largely, it seems. You often see analysis in the financial press for crypto focusing on technical or chartist patterns, which emphasize psychological factors, market sentiment, trading momentum, rather than traditional economic fundamentals like cash flow or utility. This heavy reliance on sentiment rather than intrinsic value makes them highly susceptible to rapid swings, herd behavior, and speculative bubbles.
Speaking of bubbles, what about NFTs, non-fungible tokens? They had a huge moment.
Right. NFTs are a prime example of this dynamic. They are unique digital assets stored on a blockchain, representing ownership of, well, almost anything: digital art, collectibles, virtual land, music. The report describes the NFT market as exhibiting classic characteristics of an investment mania and bubble.
Strong words. Mania and bubble.
Yeah. While proponents sometimes draw parallels to the traditional art market or talk about future gaming applications, the report notes that by the summer of 2022, NFT transaction volumes had fallen substantially after that period of really tremendous growth, and prices appeared to have dropped significantly across the board. This really underscores the speculative and often fleeting nature that can drive crypto asset valuations.
Okay. Beyond price volatility and speculation, what else makes the system fragile internally?
Another critical point the report raises is the quality, or often the lack thereof, of disclosures provided by crypto asset projects.
Disclosures, like information for investors.
Exactly. Unlike public companies, which face really strict regulatory disclosure requirements, think quarterly earnings reports, audited financials, risk factor disclosures.
Right, lots of paperwork.
Right. Crypto asset projects are typically promoted through things like white papers and social media campaigns. And the report finds these communications are often unclear or more technically complex than an average investor may be able to fully understand.
So hard to decipher even if you try.
Sometimes, yes. Or, in other cases, these so-called white papers are described as being a little more than a few pages of graphics and some promotional language. They severely lack the crucial information that traditional investors rely on.
Like what kind of information is missing?
Things like clear rights for the token holders, details about the management team and their experience, audited financial statements, even basic info about funding sources or how investor money is being used. And disturbingly, the report states they can frequently contain misleading or false statements or omissions, basically painting an overly rosy picture without proper substantiation.
Okay, so it's hard for investors to know what they're really buying into.
Very hard. The lack of standardized, reliable disclosure is a major vulnerability.
And then, of course, moving beyond just poor disclosure, there's the issue of outright fraud and market manipulation, which seems disturbingly common in this space. It's not just about making a bad investment. It's about people actively trying to steal your money.
Indeed, the report makes it abundantly clear that there have been many instances of fraud and market manipulation in crypto asset markets. These aren't just isolated incidents.
How do these scams typically work?
Well, market manipulation schemes are often designed to artificially inflate the price of a specific crypto asset, maybe through coordinated buying or spreading false news, creating this illusion of momentum and investor interest. Then the fraudsters dump their holdings onto the unsuspecting buyers who jumped in late. This undermines any confidence in the integrity of that asset's price. And the unraveling of these schemes invariably leads to substantial and sudden declines for everyone else left holding the bag.
And outright fraud, like Ponzi schemes.
Absolutely. And theft. The data from the report on losses is just staggering.
Yeah.
Billions of dollars have been lost to financial scams and what are known as rug pulls.
Rug pulls. Explain that.
A rug pull is a particularly nasty type of scam in the crypto space, where the developers behind a project suddenly abandon it and disappear with all the investors' funds that were locked into the project's smart contracts or pulled for liquidity. It's like they literally pull the rug out from under their investors.
Wow. How much money are we talking about lost overall?
The report shows figures like, in 2019, nearly $9.5 billion was estimated lost to scams and theft globally. In 2021, over $7.8 billion. These are immense numbers. Think about that. Billions of dollars just vanished, often from ordinary people who got lured in by promises of quick riches.
That's devastating. Are regulators seeing this in complaints?
Oh yeah, public complaints vividly illustrate the scale. The SEC, the Securities and Exchange Commission, received over 23,000 tips, complaints, and referrals related to crypto asset activities just since fiscal year 2019.
23,000. What are people complaining about?
All sorts of things. Problems with initial coin offerings, ICOs, issues accessing funds and wallets, operational problems on trading platforms, pricing manipulation, and these high-yield investment schemes that turn out to be frauds. And complaints to other agencies like the Consumer Financial Protection Bureau, CFPB, and the Federal Trade Commission, FTC, show similar sharp increases. The FTC reported a median individual loss of $2,600 from investment scams involving crypto.
2,600 bucks. That's not pocket change for most people. That's a real hit.
It's a significant hit to someone's personal finances, a real consequence of this less regulated environment. The report even cites examples of large-scale Ponzi schemes that have been prosecuted, like the Bitcoin Savings and Trust, $4.5 million, and a CFTC charge scheme that attracted $44 million from investors.
It's kind of ironic, isn't it? Blockchain is supposed to be transparent.
Right, that's the irony. While some proponents argue that blockchain's transparency should mitigate fraud because everything's on a public ledger, the report points out that this very transparency can also create opportunities for new types of attacks.
Like
Things called sandwich attacks, where sophisticated traders spot a large pending transaction on the public ledger, quickly place their own buy order just before it, and a sell order just after it, effectively sandwiching the victim's trade to profit from the price impact they create, or something called minor extractable value, or MEV.
MEV.
Yes, basically the profit miners or validators can extract by strategically including, excluding, or reordering transactions within the blocks they produce. They can prioritize transactions that pay them higher fees, or even front-run large trades they see coming. It's a subtle but significant form of exploitation enabled by the system's transparency.
Wow. Okay, so prices are volatile, disclosures are poor, fraud is rampant. What about the structure of the platforms themselves? You mentioned earlier how they combine lots of functions. How is that a vulnerability?
Right. The integrated suite of services offered by many crypto platforms, trading, lending, custody, market making, all under one roof. What's fascinating and concerning from a stability perspective is that unlike traditional financial institutions like banks, which are subject to really robust prudential regulation, capital requirements, liquidity rules, and benefit from a public safety net like deposit insurance, major crypto asset platforms typically aren't regulated in the same comprehensive way.
So they're doing bank-like things without bank-like rules.
In many ways, yes. They combine services like facilitating customer trading, custodying customer assets, maintaining order books, acting as a market maker, trading against their own customers, providing margin lending, issuing stablecoins, offering high-yield investment products. This integrated structure, while maybe convenient for users, creates those significant conflicts of interest we talked about.
Can you give an example?
Sure. If a platform custodies your assets and acts as a market maker for those same assets and offers you margin loans against them, they might have an incentive to liquidate your position quickly if the market moves against you, perhaps faster than an independent broker would, because they might profit from the liquidation or want to reduce their own risk exposure. Their interests aren't necessarily aligned with yours.
Yeah, that doesn't sound good. And what happens if one of these big integrated platforms fails?
That's a major concern. The report highlights that the failure of a large integrated platform could trigger a downward liquidity spiral, meaning if a big platform suddenly halts withdrawals or collapses, it could cause panic, leading to abrupt reductions in liquidity across the entire market and causing trading spreads, the difference between buying and selling prices, to widen dramatically.
Has this happened?
We've seen elements of it. The report notes specific instances where some platforms made substantial loans to other crypto entities that later went bankrupt, citing examples like Celsius and Voyager Digital. This clearly demonstrates critical and often opaque operational interconnections. One failure can pull others down. Furthermore, trying to evaluate whether these platforms have enough capital and liquidity buffers to withstand shocks is really challenging because there's very limited publicly available information about their internal operations and risk management practices.
So we don't really know how risky they are internally.
Often we don't have a clear picture. while some in the crypto space argue that automated liquidation mechanisms in DeFi or on platforms provide a kind of first line of defense against losses.
Hmm.
The report rightly questions whether this automated selling truly replaces the need for robust capital reserves and traditional risk management, which are designed to absorb losses and prevent systemic collapse, not just automatically liquidate users.
Hmm. Okay. I recall hearing about whales in crypto. These individuals or entities holding massive amounts of a particular coin. Does the report touch on how that concentrated ownership impacts stability? It feels like a single large seller could really move the market.
Absolutely. The report clearly identifies that crypto asset markets show distinct risks stemming from concentrated exposures to single large counterparties or investors. They point directly to the widely publicized failure of Three Arrows Capital, which was a major crypto hedge fund. Its collapse had significant fallout across the industry, and commentators widely blamed its extensive, often hidden interconnections and massive leveraged positions in various crypto assets.
So one big failure caused ripples everywhere.
Exactly. This kind of concentration means that the actions or failures of just a few large players can have really outsized destabilizing effects on the entire market.
Yeah.
And the data on concentration is pretty stark. A study cited in the report found that at the end of 2020, the top 1,000 market participants owned roughly one-sixth of all Bitcoin in circulation.
1,000 people owned a sixth of all Bitcoin.
Yeah.
Wow.
Yeah. And the top 10,000 participants owned about one-third. This level of concentration creates a clear potential for significant financial instability. If even a few of these whales decide to sell large amounts or are forced to liquidate due to margin calls, it can trigger widespread price declines and contagion across the whole ecosystem. It's like having too much weight concentrated in just a few hands.
Okay, so the market structure, the concentration, what about the technology itself? Distributed ledger technology, smart contracts? Uh, They're supposed to be the groundbreaking secure part, right? But you're saying the tech itself can also introduce vulnerabilities. How does that work? It's supposed to be the solution, not the problem.
That's a really critical question. Can the underlying technology itself be a source of risk? And the answer, as outlined clearly in the report, is a definite yes. Think of the DLT, the blockchain, as the very foundation. In what are called permissionless systems like Bitcoin or the public Ethereum network, where basically anyone can join, run the software, and validate transactions.
Right, the open ones.
Bugs or errors in the underlying core code can be incredibly difficult to patch quickly or sometimes at all, because you need widespread consensus among all these independent participants to accept an update, and that can be slow or contentious.
Okay, so fixing bugs is hard in decentralized systems.
It can be. Conversely, in permission systems, which are often used by businesses or consortiums where participation is restricted and usually a central entity or group maintains control,
The more private blockchains?
right, even changes implemented by that central entity, if not rigorously tested, can inadvertently cause disruptions or unexpected problems for the users of that system. The sheer complexity and novelty of the code itself, whether permissionless or permissioned, introduces inherent operational risks. Things might not work as intended.
Okay, so bugs in the code. What else on the tech side?
Well, beyond the core code, the participants who are essential to making the network actually run the miners and validators also present risks.
How so? They're supposed to be securing the network.
They are, but there's a theoretical potential for collusion among them, especially if a few large mining pools or staking validators control a significant portion of the network's processing power or staked assets. They could potentially collude to undermine the integrity of the network, maybe by censoring certain transactions or even attempting to rewrite recent history on the chain, though that's very difficult.
Okay, collusion risk.
And there's also an economic risk related to them. The economic incentives for miners, particularly in proof-of-work systems like Bitcoin, are directly tied to the price of the crypto asset they earn as rewards, minus their costs, primarily electricity. This can create what the report calls pro-cyclical financial pressure.
Pro-cyclical, meaning it makes booms bigger and busts worse.
Exactly. When crypto prices fall significantly, miners might find it unprofitable to continue operating. So they might shut down their mining rigs, taking their capacity offline.
Okay, so less computing power securing the network.
Right. And that reduction in capacity can, in turn, reduce the transaction throughput on the network, make it slower or harder to get transactions confirmed. And that inconvenience or slowdown can further depress prices, creating a negative feedback loop. Prices fall, miners leave, network slows, prices fall more.
Ah, downward spiral.
Potentially, yes. The report shows, for instance, that Ethereum's gas fees, which are basically the transaction costs users pay to miners or validators, can become extremely high, especially during times of market stress or high congestion. This can make transactions either prohibitively expensive for small users or just incredibly difficult to get processed in a timely manner.
I've heard about high gas fees making things unusable sometimes.
It can be a real issue. And there's even evidence cited of large commercial miners having to sell more Bitcoin than they actually mined during the market downturn in spring 2022, just to cover their operating costs and debt loads. That illustrates this financial pressure they face. Plus, a subtle point. Unlike traditional banking where you choose your bank, in most public blockchains, you can't choose which specific miner or validator processes your transaction. This could potentially expose you to interacting with entities that might not be in compliance with relevant laws, like sanctions.
Interesting point. Okay, let's talk about runs. It sounds so old-fashioned, like something from a black and white movie about the Great Depression queues of people outside a bank demanding their money. Do runs really happen in the crypto world? How are they comparable? It feels like a very old world problem for these supposedly new world assets.
It's fascinating, isn't it, how these old financial patterns can reappear in entirely new technological wrappers. Putting this into the broader historical context, the report emphasizes that runs are indeed an endemic feature of financial history. They've happened repeatedly and have caused severe economic harm for millions of Americans over the centuries.
Okay, so runs are a known historical risk. How does crypto fit in?
Well, the report stresses a fundamental difference between traditional finance today and much of the crypto ecosystem. Many of the safeguards that were specifically built into traditional finance to prevent runs things like robust capital requirements for banks, stringent financial reporting rules, liquidity regulations, crucial federal deposit insurance, and importantly, access to lender of last resort facilities from the central bank. These are broadly absent from the crypto asset ecosystem.
So fewer safety nets in crypto.
Exactly. Consequently, and this is a critical observation from the report, runs, withdrawal restrictions, failures, and panics have occurred in crypto asset markets at a high frequency because there are simply fewer built-in shock absorbers when confidence falters.
Okay. Where are runs most likely? Are stablecoins particularly vulnerable? They sound stable.
The name can be deceiving. Stablecoins, despite their name suggesting safety and stability, are highlighted in the report as being particularly vulnerable to runs. Their market capitalization grew substantially through early 2022, making them systemically more important within crypto. But this growth also brought increased scrutiny and risk.
And the report gives an example, right? Terra USD.
Yes, the report focuses heavily on the dramatic collapse of the Terra USD stablecoin in May 2022 as a really stark illustration of these run risks. It's worth unpacking that briefly because it shows how quickly things can fall apart.
Okay, break it down for us.
So, Terra USD background. At its peak, Terra USD, or UST, was the third largest stablecoin globally, with a market cap over $18 billion. That's huge. What made it unique, and ultimately vulnerable, was that it was an algorithmic stablecoin.
Algorithmic, meaning no actual dollars backing it.
Largely, yes. It purportedly maintained its value, its one-to-one peg with the US dollar, not by holding equivalent dollars in a bank account, but through a complex algorithmic mechanism. This involved allowing holders to always exchange one UST for $1 worth of Luna, which was an affiliated but highly volatile governance token. The idea was arbitrageurs would keep it stable. There was also a related entity, the Luna Foundation Guard, which reportedly held about $3.5 billion in Bitcoin reserves to help support the peg, although regular UST holders couldn't directly redeem their UST for that Bitcoin. Its entire credibility ultimately rested on the assumption that Luna, the volatile token, would always have a non-zero value. It created this kind of fragile circular dependency.
Okay, so its stability depended on the price of another volatile crypto token. What went wrong?
The collapse. The fundamental problem was that Luna's price was largely driven by speculation and the market's perception of Terra USD's stability, not underlying fundamentals. When UST started to lose its peg, maybe due to large withdrawals or market pressure, the exact triggers debated and dipped below $1, the algorithmic mechanism couldn't cope. People rushed to redeem USD for Luna, flooding the market with Luna, causing Luna's price to crash. As Luna's price plummeted towards zero, the mechanism broke entirely. The market completely lost confidence, a massive sell-off ensued, and both Terra USD and Luna rapidly collapsed. Their prices just nosedived to near zero within days.
Billions in value wiped out just like that.
Just like that. The report includes some stark charts showing these dramatic price and market cap drops for both UST and LNA. It visually demonstrates just how quickly tens of billions of dollars in perceived value evaporated.
And did this collapse affect other parts of the crypto market? Was there contagion?
Contagion, absolutely.
This wasn't just an isolated event affecting UST and Luna holders. The Terra USD collapse reportedly triggered a temporary run, or at least heavy withdrawals, even on Tether, which is the largest stablecoin by market cap and is supposed to be backed by traditional assets. Investors suddenly got nervous about all stablecoins.
So fear spread quickly.
Very quickly. And it had much broader impacts across the crypto market. It directly contributed to the failure or bankruptcy of several other major firms that were heavily involved in crypto asset market making, lending, and venture capital. The report specifically mentions high-profile bankruptcies like Celsius Networks, a huge crypto lender, and Voyager Digital, a crypto brokerage, as being impacted by the Terra fallout, often due to loans they had made that were linked to Terra Luna or the general market crash it triggered.
Wow, so one stablecoin failure took down major lenders and brokers. It was a major contributing factor, highlighting the hidden interconnections. The report visually demonstrates this contagion too, showing a clear drop in total value locked, which is a common metric measuring the amount of assets deposited in DeFi protocols across many different DeFi protocols, even those not built on the Terra blockchain itself, immediately following Terra USD's collapse. It really underscores how quickly fear and loss of confidence can ripple through these interconnected crypto markets, causing widespread damage even without direct exposure.
That's a sobering example. Okay, one more vulnerability. Leverage. It's a common tool in traditional finance, lets you amplify returns or losses. How does leverage play out in crypto, especially with these integrated platforms? Does it make the volatility worse? It feels like a classic double-edged sword.
It absolutely is a double-edged sword, and in the crypto world, it often feels like it's wielded with far fewer safety precautions. The use of high leverage by market participants in the crypto ecosystem is identified as another significant vulnerability. It makes participants incredibly sensitive to any negative shocks, whether that's bad news about a specific crypto project, a hack, or just broader negative macroeconomic developments.
How does it make them sensitive?
Well, if you've borrowed heavily to buy crypto, even a small drop in the price of your assets can trigger a margin call or, more often in crypto, automatic liquidation of your collateral. This forced deleveraging, when it happens across many participants simultaneously, creates waves of cascading liquidations. One person's forced selling drives the price down, triggering the next person's liquidation, and so on.
Amplifying the crash.
Exactly. High leverage significantly amplifies the volatility and procyclicality of asset price declines, as the report puts it. It turns downturns into routes. And the report's data backs this up, clearly showing that significant drops in Bitcoin prices have repeatedly coincided with very elevated volumes of liquidations of long Bitcoin positions on derivatives exchanges. The leverage fuels the fire on the way down.
How much leverage are we talking about?
Some crypto platforms, even those easily accessible to retail investors, reportedly offer leverage as high as 10x, 20x, or on some offshore exchanges, even 100x on certain derivative products. That means a user could control, say, $100,000 worth of Bitcoin with only $1,000 of their own capital.
That's insane leverage for a retail person. The potential for losses must be huge.
Astronomical. And the report notes that much of the activity on DeFi protocols, which saw really substantial growth in assets locked during 2021, also appears to involve the widespread use of leverage, often through complex borrowing and lending protocols, where users deposit one crypto asset to borrow another.
And what happens when things go wrong with leverage in DeFi?
When predefined collateralization ratios are breached, meaning the value of the collateral you posted falls too low relative to the amount you borrowed, automated liquidations kick in via the smart contract. These liquidations often include a hefty liquidation fee, sometimes called a liquidation bonus, for the entity performing the liquidation, or a liquidation penalty for the borrower. This fee is taken directly out of the value of the collateral being sold.
Are those fees clear up front?
That's a problem. The report highlights that these potentially significant fees are frequently not clearly disclosed to the user at the point of borrowing. You might have to dig deep into FAQs or obscure protocol documentation to find them, making it really difficult for average investors to understand the true cost of their position being liquidated.
So you get wiped out and hit with a hidden fee.
Pretty much. Now, while human intervention is generally limited in these automated smart contracts, the report does mention there have been some instances where DeFi protocols facing extreme market stress actually adjusted their policies via emergency governance votes among their token holders. They did this specifically to try and reduce the risk of large-scale cascading liquidations that could have potentially collapsed their entire protocol. Examples cited include platforms like Solend and Curve taking emergency actions. But that itself raises questions about the true decentralization and predictability of these systems if rules can be changed on the fly during a crisis.
Okay, so we've laid out the internal vulnerabilities, the shaky foundations, the potential for runs, the risks of leverage. But what are the external triggers, the actual shocks that can hit the system and cause these vulnerabilities to really bite? Where do these destabilizing shocks come from beyond just, say, bad market sentiment or a sudden price drop?
Right. That's the next piece of the puzzle. The report highlights several distinct sources of external shocks, making it clear that the risks aren't just self-inflicted wounds from within the market. These external triggers can be quite potent, often unexpected, and frequently outside the control of individual crypto projects or investors.
So what's a major source of these shocks?
Well, this brings up an important question. Are malicious acts just an inherent part of operating in this space? The report basically confirms that, yes, shocks from malicious actors are likely and, unfortunately, quite frequent. And we're not just talking about the fraud and market manipulation we discussed earlier, which are bad enough. We're talking about direct theft or misappropriation of crypto assets.
Hacking, basically.
Hacking, scams,
Yeah.
exploits, yeah. And remember that relative immutability of crypto transactions we talked about. While it has security benefits, it also means that if a malicious act like theft does occur, the transaction is incredibly difficult, if not impossible, to reverse. The money is likely gone for good.
And are these systems easy to attack?
The highly technological nature of the crypto ecosystem unfortunately offers numerous potential weak points for attack. These can range from vulnerabilities in the smart contract code itself, to insecure digital wallets used by individuals, to exploits targeting the bridges that connect different blockchains. And sadly, the perceived anonymity or pseudonymous nature of crypto asset activities can help bad actors evade identification after an attack. They often use sophisticated obfuscation techniques.
Like the mixers you mentioned.
Exactly. Things like cross-chain hopping, rapidly moving stolen funds between different blockchains to make them harder to trace. Utilizing opaque Layer 2 protocols, these are scaling solutions built on top of blockchains that can sometimes offer less transaction transparency. Employing mixers or tumblers which blend crypto from multiple sources, and converting stolen funds into anonymity-enhanced privacy coins, all designed to break the chain of traceability.
Just how big a problem is this theft and hacking?
The scale is genuinely significant, running into billions of dollars annually across the industry. The report includes data tracking the estimated volume of funds stolen via DeFi hacks alone, noting interestingly that the total value of stolen funds often correlates with the price of Bitcoin itself, suggesting higher valued assets are more tempting targets for attackers.
Any specific big examples?
Oh yeah, the report cites a particularly notorious one, the approximately $620 million hack of the Ronin network in early 2022. Ronin is an Ethereum sidechain specifically built for the popular crypto game Axie Infinity. The FBI publicly attributed that massive theft to North Korea's state-sponsored hacking group, known as the Lazarus Group.
$600 million from one hack
Yeah.
attributed to North Korea. Wow.
Yeah, it highlights the scale and even the geopolitical dimensions of these risks. Other forms of attack highlighted in the report include flash loan attacks, which are complex exploits where attackers borrow huge sums with no collateral, manipulate market prices, and repay the loan all within a single transaction, netting a profit. Also, 51% attacks, where malicious actors gain control of a majority of a network's mining or validating power, allowing them to potentially manipulate governance or even reverse recent transactions. And things like airdrop phishing, scams designed to trick users into revealing their private keys or approving malicious transactions by promising them free crypto assets or NFTs. These aren't simple smash-and-grab robberies. They're often sophisticated attacks targeting the very design and complexity of crypto protocols.
Okay, so malicious attacks are a major source of shocks. What about non-malicious tech failures? Just things breaking, like a software update going wrong, but maybe with billions of dollars at stake?
Precisely. That's another significant source of potential shocks. It's not always about bad actors. The very novelty and inherent complexity of crypto technology mean that non-malicious coding issues are a real and ongoing threat.
What kind of issues?
These can include simple bugs in smart contract code that maybe weren't caught during audits. unexpected problems arising when publicly available code libraries are integrated incorrectly by developers, or even failed protocol upgrades that might inadvertently cause widespread disruptions or halt transactions across an entire network. We've seen major blockchains experience outages or severe slowdowns due to technical glitches.
Okay, code bugs. What else?
Well, the whole ecosystem relies heavily on global communications technology, the internet, basically. So it's exposed to shocks from potential internet outages, disruptions to cloud service providers where nodes might be hosted, or other failures and crashes related to the traditional technology infrastructure that ultimately underpins the crypto world.
Right, it doesn't exist in a vacuum.
Not at all. And finally, a broad set of non-malicious technology-related security breaches can occur. A really basic but critical one is the loss or theft of private keys, those secret cryptographic codes that actually control access to your crypto assets. If you lose your key, you lose your crypto, period. The report even cites a lawsuit alleging a $75 million loss due to this very issue, highlighting that even fundamental operational security can fail. Other examples could include disruptions to the systems handling off-chain transactions or even failures in the underlying encryption systems used. All of these can lead to significant losses or system disruptions without any malicious intent necessarily being involved, just things breaking. This leads us to a third potential source of shocks: governance or decision-making breakdowns. This raises an important question about how these systems, which are often promoted as being decentralized and therefore resilient because there's no single point of failure, actually make critical decisions, especially during a crisis.
Right. If there's no CEO who's in charge when things go wrong.
Exactly. Some management functions in crypto asset activities are largely programmatic, meaning they're governed by the rules embedded in the code and automated processes. In such cases, the capacity for human intervention during a crisis like halting trading, patching a critical bug, or changing risk parameters often depends entirely on achieving consensus through governance votes among the holders of specific governance tokens associated with that protocol or blockchain.
So the token holders have to vote to fix things. What if they can't agree?
That's precisely where breakdowns can happen, especially in systems that feature significant fragmentation or decentralization. If a consensus among the various governance token holders, or maybe the miners or validators, cannot be reached quickly enough, it can lead to a kind of paralysis. The system is unable to take necessary actions to address a crisis. Imagine a ship caught in a storm and the crew can't agree on which way to turn the wheel.
Okay, paralysis is one risk. What else?
Alternatively, these very governance arrangements are also potentially vulnerable to those 51% attacks we discussed earlier in the context of malicious actors. If someone, maybe a hostile actor, manages to acquire a slim majority of the voting tokens or control a majority of the mining power, they could potentially exert undue control over the network's future direction, or even try to manipulate past transactions if the system allows.
So someone could buy enough votes to hijack the system?
In theory, yes, for some systems, especially smaller ones. The report also notes that even if it's not a malicious 51% attack, just having highly concentrated control among a few large token holders, even if they're well-intentioned, can distort decision-making. Their interests might not align with the broader community of users.
Okay. What if there's disagreement on a major upgrade?
That's another governance failure mode. If competing proposals for significant protocol updates can't be agreed upon due to a governance deadlock, a crypto asset's blockchain might end up forking. This essentially means the chain splits into two separate, incompatible versions running in parallel.
Like the blockchain splits in two, what happens then?
It creates huge uncertainty. Which chain is the real one? Will exchanges support both? It disrupts the use of the original crypto asset, fragments the community, and can potentially lead to runs or broader investor sell-offs as confidence just erodes. It demonstrates that even the system's own internal decision-making process, its governance, can itself be a significant source of instability and shocks.
Okay, so we've painted a pretty stark picture. Inherent vulnerabilities within crypto, combined with potential shocks from hacks, tech failures, and even governance breakdowns. It sounds risky. So with all this swirling around, what exactly are regulators and policymakers doing about it? How are they attempting to create guardrails, bring some order to what often seems like chaos, or at least a very fast-moving, hard-to-pin-down target?
That really is the trillion-dollar question right now, isn't it? And the Financial Stability Oversight Council, the FSOC report we've been discussing, provides a crucial overview here. It outlines both the regulatory tools that already exist and are being applied, but also makes critical recommendations for future legislation and action. The core finding, the bottom line of the report, is crystal clear. The risks posed by crypto assets will significantly escalate if their interconnections with the traditional financial system or their overall scale were to grow without being paired with appropriate regulation.
So basically, regulate it before it gets big enough to cause a major crisis, not after.
Exactly. It's a call for proactive measures rather than just reacting after something blows up.
Okay, so what are the existing tools? How are regulators using the rules they already have, especially thinking about consumer protection?
All right, let's start with the existing frameworks. Traditional financial entities like banks, credit unions, and trust companies operate under a pretty well-established regime. They're generally restricted to activities deemed permissible under banking law. They have to conduct them in a safe and sound manner, and they face robust prudential oversight, capital rules, liquidity rules, regular exams.
And can banks use crypto under these rules?
Cautiously, yes. The Office of the Comptroller of the Currency, the OCC, which regulates national banks, has issued interpretive letters over the past few years. These basically affirm that national banks can indeed provide crypto custody services, they can hold reserves backing stablecoins, and they can even act as nodes on blockchain networks to facilitate payments, provided they do so safely, manage the risks appropriately, and adhere to existing banking regulations. So it indicates a cautious but clear path for traditional banks to engage, but within their existing stringent regulatory perimeters.
Okay. What about protecting consumers directly? There seems to be a lot of confusion out there.
That's a huge area of focus, absolutely. Consumer protection is paramount, particularly concerning the misrepresentation of things like deposit insurance. Regulators like the Federal Deposit Insurance Corporation, FDIC, which insures bank deposits, and the National Credit Union Administration, NCUA, which insures credit union deposits, are deeply concerned because they've seen crypto platforms sometimes misleadingly refer to customer accounts as deposits or imply that the crypto assets held there are insured, like bank accounts.
Which they absolutely are not.
Absolutely not. The stark reality is that crypto assets held in custody by an exchange or platform are not covered by federal deposit insurance if the platform fails. This is a critical distinction that many consumers just don't grasp, often because of misleading marketing.
So what are the FDIC and NCUA doing about that?
They've been very active. The FDIC, for example, has issued public advisories clarifying the limits of deposit insurance. They've even issued formal cease and desist letters to specific crypto platforms and partner banks demanding they stop making false or misleading statements about FDIC insurance coverage. They're really trying to stamp out that confusion to prevent consumer harm when platforms fail.
Okay, federal bank regulators are on it. What about state regulators?
State regulators play a significant role too, particularly in licensing and overseeing crypto businesses that operate within their borders. A well-known example is New York's BitLicense regime for virtual currency businesses, which was actually introduced way back in 2015. It imposes requirements like minimum capital levels and surety bonds, aiming to bring a level of financial stability and consumer protection accountability to crypto firms operating in New York.
Are other states doing similar things?
Yes. The report mentions other states like Louisiana, Nebraska, and Wyoming have also enacted specific requirements or charter types for digital asset businesses. These state-level regulations are an important part of the overall patchwork of oversight, although the fact that rules differ state by state can also create a fragmented and sometimes confusing regulatory landscape for businesses operating nationally.
Makes sense. What about the big market regulators, the SEC and CFTC? They deal with stocks and derivatives. How are they involved?
They are very actively involved, often bringing enforcement actions based on existing laws. The Securities and Exchange Commission, the SEC, for example, views many crypto assets as potentially being securities under the long-standing Howey test derived from a Supreme Court case.
Meaning they should be registered and regulated like stocks.
Potentially, yes, if they meet the definition of an investment contract. As of July 2022, the report noted the SEC had brought 96 crypto asset-related enforcement actions. This shows their commitment to applying existing securities laws to the crypto space, particularly targeting unregistered securities offerings, ICOs, fraud, and platform activities they deem non-compliant. State securities regulators are also coordinating their efforts with the SEC and bringing their own cases.
Okay, so the SEC is focused on whether crypto assets are securities. What about the CFTC?
The Commodity Futures Trading Commission, or CFTC, generally considers Bitcoin and certain other established virtual currencies to be commodities, like gold or oil. Therefore, they actively regulate the markets for crypto futures and other derivatives based on these commodities. They brought over 50 enforcement actions as of the report date, targeting things like fraud, market manipulation like pump and dump schemes, and Ponzi schemes operating in the crypto derivatives markets they oversee.
So both the SEC and CFTC are claiming jurisdiction, sometimes over the same assets, it seems.
That's part of the ongoing regulatory debate and uncertainty, yes. Which agency regulates which specific crypto asset or activity is sometimes unclear and contested, leading to calls for more legislative clarity.
Okay, so we have this patchwork of existing agencies applying old rules, sometimes with difficulty. What does all this regulation, both the existing enforcement and maybe potential new rules, actually do for market behavior? Does it help calm things down?
That's the goal, certainly. The FSOC report suggests that even existing regulation, when effectively applied, can have a positive impact. For example, regulation related to leverage, like margin requirements imposed by the CFTC on futures contracts, can directly dampen excessive speculative price movements by limiting how much participants can borrow, thereby reducing the amplitude of market swings.
Okay, less leverage equals less volatility, potentially.
Potentially, yes. And more generally, any regulation that increases transparency in the crypto asset ecosystem is seen as beneficial. Think about things like public reporting requirements for platforms or mandating regular audited attestations for stablecoin reserves, something already required for stablecoins approved by the New York Department of Financial Services, NYDFS. This kind of information helps market participants price assets more accurately based on real data, not just hype. And that, in turn, can help mitigate the formation of asset price bubbles by fostering more rational decision-making. It's fundamentally about bringing light and facts into what has often been a very opaque market.
Makes sense. Transparency helps. But the FSOC report didn't just describe the existing situation, right? It made recommendations for new rules. What were the key ones?
Exactly. The FSOC report went beyond just mapping the current landscape and identified critical gaps in the regulatory framework where they believe existing authority isn't sufficient. Based on these gaps, they made specific, concrete recommendations to Congress for new legislation. These aren't just minor tweaks. They're seen as pretty essential for managing future financial stability risks.
Okay, what's the first big recommendation?
One of the most significant is Recommendation 5, which focuses squarely on stablecoins. Given their importance and potential run risk, the Council explicitly recommends that Congress pass legislation to create a comprehensive federal prudential framework specifically designed for stablecoin issuers.
Prudential framework, meaning bank-like regulation.
Essentially, yes. Regulation focused on safety and soundness. This framework would address key risks like market integrity, investor and consumer protection, and importantly, the potential risks stablecoins could pose to the broader payment system if they become widely used for transactions. It would also cover entities that perform services critical to how stablecoins function, like wallet providers.
So why do stablecoins need their own special rules, separate from other crypto? What stands out to you about why they singled them out?
I think it's because stablecoins occupy this unique, critical position in the ecosystem. They purport to be stable, unlike other crypto assets. They act as the main bridge between traditional fiat currency and the volatile crypto world, used for trading, collateral, and potentially payments. Their failure, as we saw vividly with Terra USD, can have really widespread contagion effects far beyond just their direct holders. They touch so many parts of the system. That makes them a potential point of systemic risk that warrants specific, robust oversight, arguably more akin to bank or money market fund regulation.
Okay, dedicated stablecoin rules. What's another major recommendation?
Then there's Recommendation 6, which tackles the problem of regulatory arbitrage and lack of visibility. The report points out that crypto asset entities often have really complex operational and organizational structures. They might have different affiliates or subsidiaries conducting different activities, perhaps registered under different regulatory umbrellas, or sometimes operating completely outside any regulatory perimeter.
Meaning it's hard for any one regulator to see the whole picture.
Exactly. It can mean that no single regulator have a comprehensive view of the entire entity's risks, creating dangerous blind spots. Therefore, the Council recommends legislation specifically to give regulators visibility into and otherwise supervise the activities of all of the affiliates and subsidiaries of crypto asset entities. This should apply regardless of any claims of decentralization these entities might make about their structure.
So closing the loopholes that let firms hide risk in unregulated corners.
Precisely. It's fundamentally about preventing regulatory arbitrage, where entities deliberately structure themselves to exploit gaps or differences between various regulatory regimes, like state versus federal or U.S. versus offshore, to avoid oversight. That kind of gamesmanship can hide significant risks from both regulators and the public.
Makes sense. Any other key recommendations?
Yes, finally, there's Recommendation 8, which addresses the issue of vertical integration. This refers to the common crypto model where retail customers often directly access markets and services through a single platform that combines functions traditionally separated: brokerage, exchange, clearing, custody, all without those traditional intermediaries.
The one-stop shop problem again.
Right. The report flags that this model creates those inherent conflicts of interest we discussed, like the platform trading against its customers or having incentive to liquidate them. It also poses unique investor and consumer protection issues that require really robust disclosures and specific rules of conduct.
So what's the recommendation? Ban it.
Not necessarily ban it, but urging the relevant agencies to carefully assess the impact of this vertical integration. They need to determine if and how these vertically integrated structures can or should be accommodated under existing laws and regulations, or if entirely new regulatory approaches are needed to adequately manage the specific risks and conflicts they pose to investors and the market. It's about figuring out how to regulate this new market structure safely.
You know, it all sounds so incredibly new and complex, sometimes algorithmic stablecoins, decentralized finance protocols, zero-knowledge proofs. But what's truly fascinating, and something the Treasury report really leans into, is drawing these compelling parallels to past financial eras. How does looking back at history actually help us understand crypto today? It feels like finding old maps might help us navigate this new territory.
That's a perfect analogy. This part of the report is where you get some truly powerful aha moments. It shows that many of the core challenges posed by crypto's rapid growth, the regulatory puzzles, the stability concerns, the potential for runs and manias, are not entirely unprecedented. The report details how these modern issues really evoke specific episodes from American financial history, and crucially, it highlights the enduring importance of the robust regulations that were often developed in response to those very historical crises. History doesn't repeat itself exactly, as the saying goes, but it often rhymes.
Okay, so give us an example. What's the first historical parallel they draw?
Well, one of the most striking parallels is drawn between modern stablecoins and the free banking era in the United States, which lasted roughly from 1837 to 1863.
Free banking era. What was that?
It was a period after the charter of the Second Bank of the United States, a sort of proto-central bank, expired. Without a central authority, the banking system became highly fragmented. The report notes that as many as 1,500 different state-chartered bank currencies circulated at any one time.
1,500 different kinds of money. That sounds chaotic.
It was chaotic. These were essentially private banknotes, liabilities issued by individual state-chartered banks, which were theoretically payable in gold or silver, specie, if you presented the note at the issuing bank's counter. Now, putting this into a wider context, the report argues that this historical proliferation of multiple competing private assets attempting to provide some functions and attributes of money bears some resemblance to crypto assets such as stablecoins today, especially given the lack of a consistent or comprehensive regulatory framework that many stablecoin issuers have operated under until recently.
So privately issued money-like things, unstable, poorly regulated, sounds familiar. What happened during the free banking era?
Well, state-level banking regulations varied wildly back then. Some states had strong rules, others were very lax, and historical research cited in the report shows that banks tended to fail predominantly in those states where their circulating notes were backed by risky assets, like state bonds that subsequently declined in value. Sound familiar?
Yeah, echoes of stablecoins losing their peg because of risky reserves.
Exactly. Fraud was also rampant during that era. There were schemes involving inventing non-existent wildcat banks in remote areas just to issue worthless notes, or people altering existing notes to try and pass them off as more valuable ones. The public uncertainty about the true value of different notes became so bad that it actually led to the rise of a whole industry of note evaluators and merchants constantly consulting printed catalogs called banknote reporters or counterfeit detectors just to figure out what discount to apply to notes from different banks based on their perceived risk and the issuing bank's stability.
Wow. So people were literally trading notes at discounts based on perceived risk, just like some stablecoins trade below their peg today.
Precisely. It's a direct parallel. And the clear historical lesson from the free banking era, as the report emphasizes, is that strong regulation of the collateral backing banknotes was a key factor in preventing runs and preserving financial stability. Without adequate backing and reliable oversight, the system was inherently prone to frequent panics and collapses. It ultimately led to the National Banking Acts during the Civil War, which created a more uniform, federally regulated currency.
That's a powerful parallel. Okay, what's another historical echo the report highlights?
Another really compelling parallel is drawn between the recent explosion of retail participation in crypto and the growth of the retail securities market in the early 20th century.
You mean like when regular folks first started buying stocks in large numbers?
It's exactly. The report states, and this is a great quote, that the growth in crypto asset market participation, especially at the retail level, mirrors the mushrooming of ownership of corporate stock in the United States, from less than 1 million individuals in 1910 to more than 10 million by the early 1930s. That was a truly major change in the American financial structure, bringing millions of ordinary citizens directly into the financial markets for the first time, much like crypto has done recently.
Okay, so more people got involved. What was the problem back then that relates to crypto now?
The challenge then, similar to the crypto situation now, was that many of these early stock offerings, especially before robust federal regulation, were made without adequate disclosure or market oversight. Investors were often buying into companies with very little reliable information about the business, its finances, or the risks involved. Sound familiar?
Yeah, echoes of those crypto white papers lacking key info.
Exactly. The report notes that many crypto assets today have been offered and sold without complying with existing federal or state securities laws, resulting in sales, quote, without required disclosures or market oversight, leaving investors potentially vulnerable to fraud and misinformation. The historical lesson here is profound. That prior period of rapid retail growth in stocks, characterized by similar issues of unregulated offerings, rampant speculation leading up to the 1929 crash, and a lack of transparency, directly led to the passage of the landmark federal securities laws in the 1930s, the Securities Act of 1933 and the Securities Exchange Act of 1934.
The laws that created the SEC and require companies to register and disclose information.
Precisely. Those laws created the significant legal guardrails we still rely on today, specifically designed to protect investors and ensure market integrity. They were born directly out of the painful lessons learned from that earlier era of unchecked retail speculation. The implication is clear. Similar guardrails might be needed for the crypto space.
Okay, free banking paralleling stablecoins. The 1920s stock boom paralleling crypto adoption. Is there a third parallel?
Yes, a final and perhaps more recent parallel the report points to is the development of the over-the-counter OTC derivatives markets leading up to the 2007-2009 global financial crisis.
Ah, the crisis caused by subprime mortgages and complex derivatives like CDOs.
Exactly. That period, before the crisis hit, was characterized by the incredibly rapid growth of complex and often highly opaque financial instruments and interdependencies between major financial institutions, often with hidden leverage. Think about things like credit default swaps, CDS, being traded privately between banks, or those incredibly complex structured products like collateralized debt obligations, CDOs, built on layers of mortgages. These were often difficult even for experts to fully understand, let alone price accurately, and the connections between institutions holding them were not transparent. It masked the true extent of risk building up in the system.
Right, until it all came crashing down. How does that relate to crypto?
Well, putting this into the current context, the report argues this is highly relevant to the complex interconnections and the often hidden leverage observed in today's crypto asset markets, particularly within those integrated platforms we discussed, and also in the DeFi space, where complex protocols link together in ways that aren't always fully transparent or understood.
So the worry is hidden risks and connections building up again, just in a new market.
That's exactly the concern the report raises. It's essentially saying, let's not let history repeat itself just 2 decades later. The historical lesson here, learned the hard way from the subprime mortgage crisis and the devastating financial meltdown that followed, emphasizes the dangers posed by complex and opaque interdependencies when they develop without adequate regulatory oversight and transparency. It's a powerful reminder that while financial innovation is vital, unchecked complexity and hidden risks, especially when combined with leverage, can pose truly systemic threats, not just to a niche market, but potentially to the broader financial system and economy that we all rely on. History provides cautionary tales. #tag outro.
Wow. Okay, we have taken a truly deep dive today, really unpacking the fascinating, often bewildering, and incredibly complex world of crypto assets and the accelerating efforts to bring some regulatory structure to it all.
Yeah, there was a lot to cover there, from the basic definitions right through to the historical echoes.
Absolutely. We went from defining what these digital assets truly are and the clever technological innovations like smart contracts and oracles that power them, to really understanding their inherent vulnerabilities, the intense volatility, the prevalence of fraud and poor disclosures, the risks baked into those integrated platforms, the operational tech risks, and even the potential for old-fashioned runs.
And then looking at the specific types of shocks that can trigger those vulnerabilities, hacks, tech glitches, governance failures.
Right. It's a landscape that is clearly and rightly demanding significant attention from policymakers globally. But what I found truly compelling and maybe even a bit hopeful is how history seems to offer this surprisingly clear roadmap, or at least some warning signs, showing us that many of these very modern-sounding challenges.
Like runs on private money, or manias driven by retail speculation, or dangers from opaque financial products.
Exactly. They have these clear echoes in our financial past. It really demonstrates that fundamental economic principles and maybe even fundamental human behaviors around greed and fear tend to repeat themselves, even when wrapped in shiny new technology.
It's a good reminder that technology changes, but financial stability principles often endure.
So as we look to the future with new regulations, like the ones proposed by the Financial Stability Oversight Council potentially coming down the pike, what stands out to you thinking about our conversation today, about how those past financial innovations and crises, like the lessons from the free banking era, truly illuminate the path forward for crypto regulation? How can history guide us now?
That's the big question. I think history tells us that ignoring the need for basic guardrails like ensuring stable assets are actually stable, demanding transparency, managing conflicts of interest, protecting consumers, eventually leads to crisis. The specific rules might need adapting for new tech, but the core principles remain vital.
And thinking ahead, what might be the next hidden vulnerability we need to uncover in this rapidly evolving and incredibly dynamic space? Something that maybe isn't getting enough attention right now, but could be the source of the next big shock.
That's even tougher. Maybe the increasing complexity and interconnectedness within DeFi, or perhaps the operational risks tied to the underlying internet infrastructure, or even geopolitical risks impacting miners or validators. It's hard to know what the next black swan will be in such a fast-moving area. Constant vigilance is key.
Indeed. Well, thank you for joining us on this deep dive today. It's been incredibly informative.
My pleasure. Always fascinating to dig into this stuff.
To our listeners, stay curious, stay informed, and we look forward to sharing more insights with you soon.